Imagine you're in 17th century Holland. It's a time of tulips and windmills, but also one of financial fervor. This is the story of the Tulip Mania, Europe's first major speculative bubble. In the early 17th century, tulips became more than just flowers. They were status symbols in the Netherlands. Wealthy Dutch individuals would display their prosperity by cultivating rare and exotic tulip varieties in their gardens. However, towards the end of this period, something unusual occurred. The prices of these bulbs began to soar dramatically. Let's zoom in on a specific type, Viceroy tulips. In January 1637, one bulb cost around 120 guilders. By February, it was 150 guilders. The next month, up to 1,800 guilders. And by March, some rare bulbs were selling for over 4,600 guilders, a fortune back then. Here's the kicker, most tulip traders didn't actually own the bulbs they traded. Instead, they entered into futures contracts to buy or sell tulips at a predetermined price and date. The trading wasn't about planting flowers, it was purely speculative, with traders buying and selling contracts in hopes of profiting from rising prices. Now imagine you're a regular person. You see everyone making money, and suddenly your neighbor has a fancy new carriage or house. So you start buying tulip contracts too. But here's the thing, most people didn't know much about tulips or the market for them. They just knew they could make quick profits from speculative trading. But every bubble has its peak. In early 1637, prices hit their all-time high. The rarest bulbs cost around 4,000 to 5,000 guilders, roughly 10 times a skilled worker's annual salary. That's like buying a house today for the price of an expensive car back then. And just like that, it crashed. By mid-1573, tulip bulb contract prices fell sharply, though the exact percentage decline is debated among historians. Many speculators suffered significant losses, but the extent to which people lost everything overnight or were left destitute varies across accounts and lacks precise figures. So how did this happen? Here's the math. Let's say you spend 50 guilders on one bulb. If that bulb triples in value to 150 guilders, you have doubled your initial investment, not including fees. But what if it drops back down to 50 guilders? You lose all of your original investment. And there were no safety nets for people who lost their money. The key factors were misinformation and hype. People bought tulip bulbs because everyone else was doing it, not because they understood the market or had the actual bulbs. They saw rising prices and thought, I can get rich too, but when prices began to fall, panic set in. Everyone rushed to sell at once, driving values down even faster. This bubble highlighted important aspects of human behavior. We often follow trends without critical evaluation. Seeing others profit can lead us to believe it's our turn next, despite potential disconnection from real value or risks involved. It's similar to purchasing lottery tickets after hearing about a recent large win. Now let's talk numbers for a moment. Imagine you had 10 guilders in 1634 and invested all of it in tulips. By January 1637, those bulbs could have been worth 500 guilders, a huge profit. But if you didn't sell and the crash hit, that same investment would be worth less than 20 guilders by April, almost nothing. The Tulip Mania is a classic example of why understanding financial risks and the importance of diversification is crucial. Rather than investing heavily in a single asset, spreading investments across various types of assets can help mitigate potential losses. Back in the 17th century, however, investors were not familiar with these principles. Another lesson, fees and commissions can erode investment returns significantly. Even small costs like trading fees can accumulate over time, particularly during periods of volatility or rapid price changes. This principle applies to today's financial markets as well. Minimizing expenses is crucial for maximizing long-term gains. So let's look at how this bubble compares to modern times. In 1929, we had the stock market crash that led to the Great Depression. People invested heavily in stocks under the mistaken belief that they would continue to rise indefinitely. Then came the dot-com boom and bust of the late 1990s, another case of overhyped technology stocks. And in more recent years, cryptocurrencies have seen similar wild price swings. Every financial bubble typically follows a similar pattern. Initial excitement over new opportunities leads to rapidly rising prices, which in turn draws more participants into the market. Eventually, however, the bubble bursts and prices fall sharply. Despite this recurring cycle, each episode tends to be met with assurances that it will not repeat itself. Yet history demonstrates that financial bubbles continue to occur. So why do we keep falling for these traps? Because our brains are wired to seek out quick gains and ignore long-term risks. We tend to remember large wins more vividly than minor losses, which makes it feel good to believe that we can strike it rich quickly, even when the odds are against us. Now let's circle back to why this matters today. If you hear about the next big thing, whether it's a new stock, cryptocurrency, or some other investment opportunity, and people promise sky-high returns with little risk, be cautious. History shows that such claims rarely stand the test of time. To protect yourself, learn the basics of investing. Understand how compound interest grows your money over time, why diversification reduces risk by spreading investments across various assets, and what fees can eat into your returns. Success in investing comes from consistent effort and informed decision-making, not quick paths to riches. Subject: the Tulip Mania, Europe's first financial bubble. In short, the Tulip Mania teaches us that speculative investments can lead to significant risks and potential losses. This story is not just about flowers. It serves as a cautionary tale for anyone considering high-risk investments without fully understanding them. This is educational and historical, not financial advice. Now let's dive deeper into the Tulip Mania. In 17th century Netherlands, tulips were more than just flowers. They were status symbols, luxury goods, and objects of speculation. The craze started when rare tulips with unique patterns began fetching higher prices than paintings or houses. Imagine a tulip bulb selling for 10 times the annual income of a skilled craftsman. That's how absurd things got during the Dutch Tulip Mania in the 1630s. People would trade their land, livestock, and even life savings just to get hold of these bulbs. The craze was fueled by social status and greed, much like today's investment bubbles driven by FOMO and hype. But what caused this madness? It wasn't just the allure of rare tulips, it was also misinformation and lack of transparency. Back then, there were no reliable market data or regulations to protect investors. Today, we see similar issues with cryptocurrency, where scams and fake news can spread rapidly on social media. Another key factor was leverage. People would borrow heavily to buy more bulbs, hoping to resell them at a profit. This created an unsustainable speculative bubble that eventually burst. When the market began to decline, panic set in and people scrambled to sell at any price, leading to a sharp crash in tulip prices and leaving many investors with significant financial losses. The lesson here is clear: leverage amplifies both potential gains and losses. While it can increase returns, it also significantly raises risk. This principle applies today to practices like margin trading in stocks or cryptocurrencies, where borrowing money to purchase assets can result in substantial losses if the market moves against the investor. Moreover, Tulip Mania highlights the dangers of herd mentality. During the peak in the mid-1630s, everyone believed prices would keep going up forever. They ignored warnings and dismissed anyone who questioned the bubble. This is eerily similar to how many people invest today, following trends blindly without doing their own research or thinking critically about market fundamentals. To avoid falling into such traps, always ask yourself, what's driving this price? Is it intrinsic value or hype? Are there signs of a bubble forming? Look for red flags like sudden spikes in trading volume, increased media coverage, and widespread speculation. When everyone is jumping on the bandwagon, it might be time to step back. Another critical lesson from Tulip Mania is the importance of diversification. During the speculative frenzy and subsequent crash, those who had invested heavily only in tulips suffered significant losses. In contrast, individuals who spread their investments across various assets experienced less severe consequences. Diversifying your portfolio can protect you from market volatility and reduce risk by spreading investment exposure. Finally, never invest more than you can afford to lose. The allure of quick riches is tempting, but it often leads to reckless decisions. Remember, successful investors are typically patient and disciplined, focusing on long-term strategies rather than chasing after every hot tip or get-rich-quick scheme. This approach allows wealth to compound steadily over time. In short, Tulip Mania isn't just a story from history, it's a cautionary tale for modern times. Whether you're investing in stocks, real estate, or other assets, the principles remain the same. Be informed, stay patient, and avoid getting swept up in market hype. This is educational and historical, not financial advice. Back in 1637, tulip bulbs were selling for more than 10 times the annual salary of a skilled worker. People mortgaged their homes and businesses to speculate on these rare flowers. It's easy to look back and laugh at those who invested so recklessly, but history repeats itself. During the dot-com bubble of the late 1990s, tech stocks soared without regard for fundamentals. Companies with no revenue or profits were valued in the billions. Investors bought into initial public offerings, IPOs, hoping for quick gains, much like tulip speculators who bet on bulbs they might never see bloom. Another example is the dot-com bubble in the late 1990s and early 2000s. Investors poured money into internet startups with little revenue or profit potential, driving stock prices skyward on speculation rather than fundamentals. Similarly, during Tulip Mania in 17th century Holland, people believed tulip bulb prices would continue rising indefinitely, leading them to invest exorbitant sums beyond their means. The common thread in all financial bubbles is exaggerated optimism fueled by herd mentality. People chase after the latest trend because others are doing so. However, when everyone buys simply due to hype rather than fundamental value, a correction becomes inevitable. So how do you avoid falling into such traps? First, educate yourself about the asset class you are interested in. Understand its underlying value and inherent risks. Do not rely on rumors or get-rich-quick schemes. Conduct thorough research instead. Second, maintain a diversified portfolio. Don't put all your eggs in one basket, whether it's tulips, tech stocks, or any other asset type. Diversification helps spread risk and can cushion the impact if one investment performs poorly. Third, stay patient. Resist the urge to chase short-term gains. Remember, building wealth typically takes decades through consistent saving and investing. It rarely happens overnight. In summary, Tulip Mania teaches us that financial bubbles are often driven by greed and a lack of critical thinking. Understanding these patterns can help investors stay informed, diversify their portfolios, and remain patient during market fluctuations. This is educational and historical content, not financial advice.